Hey there, everyone. Happy Friday. Today on the Final Bar, we'll talk about the S&P continuing to distribute this major benchmark closing down over 2.5% for the week. We'll dip into some of the Magnificent Seven stocks. Charts are stalling out after gapping higher. That tells you a lot about the sentiment right now. Finally, we'll open the Final Bar mailbag. What would you need to see to turn bullish here? Ladies and gentlemen, this is the Final Bar. Hey everyone, welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the market action using the power of the StockCharts platform. StockCharts was designed to empower online investors in the late 90s to understand the markets using the toolkit of technical analysis. The product and the website has evolved over time, but that mission, the vision for StockCharts has not changed. We're trying to empower individual investors, financial advisors, institutional investors, anyone in between, to try to make sense of these markets. And these are certainly uncertain times. Some of my conversations this week, I'm thinking of yesterday with Tom Bowley here in our studio, which was a lot of fun. If you missed that one, check that out. He had some really interesting thoughts about the market conditions right now, what sort of things he might need to see. You know, we're looking for signs that the market is telling us that this decline is starting to pause, that we're starting to see a finish line. Arguably, a day like today, I don't think you're seeing that, right? Earlier in the day, you saw some strength from the NASDAQ. Saw the NASDAQ actually in the green, which it did finish in the green, but look at what happened in the afternoon as we started to rotate lower. The Dow finished the entire day, spent the entire day in the red, and the S&P went from net positive to net negative. And so you have continued selling. You have a lack of willing buyers. People not really excited about jumping in, even though prices are declining, right? The way a market bottoms is you have buyers coming in. And we'll look at the charts and you'll see how for a lot of stocks, if not most of them, you're not really seeing that, with some notable exceptions. We'll try to highlight those as well. A lot to cover today here on a Friday to set you up for success for next week. And let's get started with our Wrap the Week segment. This is where we look back at what happened. We'll talk about what happened in the markets today and then really dig into some of the evidence that we're seeing through the course of this week. Just to kick things off here, the S&P finishing the day down 0.5%. I mentioned it was down about 2.6%, I think, when all is said and done. We'll have that chart here in a moment, but the S&P finishing lower today, closing just below 4120. So, you know, we talked about some of these key levels. 4200 was kind of that back of the envelope, you know, level that I know a lot of people were focusing on. The 200-day moving average, another one. Those are now in the rearview mirror. We've continued to push lower through the course of the week. This, I think, has now unlocked some of those downside targets to think about where you might anticipate a low. But at the end of the day, remember, it's all about the market actually telling you that there's a bottom. And again, I don't think we're seeing that yet. The NASDAQ composite, the NASDAQ 100 did register a positive day, which could be encouraging here going into the weekend. The NASDAQ composite up 0.4%, around 12,640. Mid caps, small caps, bright red today. The mid-cap S&P 400, the worst performer of the group, down 1.3%. Small caps down about 1%. Again, I'm going back to, you know, mentally to some of the recent conversations with some of our guests talking about small caps. And it's been a consistent theme now for a while, just lack of participation in small caps. And again, can the market rally without small caps leading the way? Absolutely. And you can see plenty of times in market history, the market has gone higher, led more by the mega caps than the small caps. But that's more the exception than the rule. In general, you think about those emerging names, right? Those names that maybe aren't great stocks today, but you're betting on them being great stocks down the road, years down the road. You buy in on weakness, and particularly you buy in when you think conditions are going to improve, because those are the names that probably in a strong economy will have the ability to grow. That's why the lack of small caps participating now is a bit of a concern. The VIX in the green as well, and that's not necessarily a great thing for stocks. Talked with some of my guests here recently about the VIX 20 level. I think that's a great level to just focus in on. And just talking with Grayson Rose here at StockCharts about some of the ways we can surface some of our breadth and sentiment data a little bit more. Just a quick, you know, stoplight sort of mentality. Is the VIX above or below 20? That should be like a thumbs up or thumbs down in terms of the environment, right? Below 20 means a low volatility, higher risk sort of environment, meaning a higher opportunity, I guess, higher opportunity, lower risk. VIX above 20 means higher risk, higher noise, higher volatility, more uncertainty, and so you probably want to look out below. We're in that sort of situation with the VIX above 20. I haven't mentioned, by the way, we did have another bear break in our yard this week. I'm taking aggressive action. We've got the trash cans in the shed. We repaired a fence. The bear still keeps coming. So again, I will report when the bear stops coming in our backyard. But this is another bearish week for the Keller family backyard, which is fully fenced in with a 6-foot fence. So I'm a little concerned about our conditions. But let's continue on with the market recap, with the wrap of the week here. Long bond yield pushing higher today, and the 5-year point actually came off. So at the end of the week, rates still going higher, and I think that's the general trend to think about. And that's not just this week thing. That's been a trend that has been in place for quite some time. The 10-year yield finished in the week around 4.85, so just slightly below 5%. The long bond yield did push above 5%, around 5.02. The 5-year point around 4.8%. So we still have that inverted yield curve, but you're starting to see the inverted yield curve, the slope is actually coming in, right? So the short end remaining elevated, the long end kind of coming up, and that's what's kind of righting the ship. Usually what happens is when conditions start to deteriorate and the Fed can lower the short end of the yield curve to sort of steepen things, that's what kind of creates this natural normalization of the yield curve. We're just not there yet, right? The Fed, the expectation as we go into November, we have a meeting next week to think about. We have the meeting in early December, mid-December, to think about 2 more meetings here in 2023. And that'll, I think, will be one of the big questions we will all have to answer is that prospect of the Fed raising rates, what that might look like to keep inflation in check. Economic data this week telling a pretty rosy story about economic conditions, and that's actually, I think, concerning for stocks here. The TLT down today about 0.4%. The dollar index slightly lower, but the UUP is right around $30 a share. Just to finish off here with today's action, commodities, a lot of green here. I'll point out gold and silver both in the positive. Crude oil prices going higher. So overall commodities really finishing the week strong, which is a noteworthy thing, particularly gold, right? A safe haven. The charts of gold and gold stocks really starting to improve here. Cryptocurrency is a little more red than green, particularly in the most commonly used coins that we track. Bitcoin currently around 33,700. Ethereum around 1775, and again, both of those are down from yesterday. Finishing off here, looking at sectors, you have the XLY moving higher. Now, one of the XLY names having a pretty decent update. That's helping the story. We'll get to those here in a minute as we can. But the XLY up 1.1%. Technology number 2 up 0.6%. Everything else flat to down for the day. At the bottom of the list, we have energy, utilities, financials, and I'd point out energy down 2.3% on energy prices doing well here going into the end of the week. All right, shall we look at the wrap the week chart? I like to look here next and just think about what we learned through the course of this week, and what we do on the final bar really sets me up for my weekend of when I am looking at charts, sort of prepare for things. I write a note for my premium members over the weekend, digging a lot deeper into some of these themes. But as a starting point to that thought process, the S&P finishing the week down 2.5%. So that's from last Friday on October 20th to where we finished today. Not a great week, and this is another rough week for stocks. And again, not that this is the only thing to look at, but it's important, I think, as a weekly routine to just take a step back and see how things have evolved. I like to look at this chart. I also have a series of chart lists that I have emailed to me from StockCharts every Friday after the close, and it looks at weekly returns for a bunch of industries, for a bunch of sectors, for a bunch of asset classes, cap tiers and styles. So I would encourage you, if you're not using that automated report feature of our chart list, you're missing out. It's a really great way of just sort of taking a step back and focusing and reflecting on what has changed. So the S&P down 2.5%. In purple or in pink here, we have the NASDAQ 100 down 2.6%. Here's crude oil. And this is using the USO ETF, finished down 2.9%. Kind of overlapping large cap stocks is small caps. In purple, we have the IWM. Almost the same return here, down 2.5% for the week. In orange, we have emerging markets, still down, but outperforming the S&P. That was down 0.7%. Everything else was up for the week. The dollar ETF, the UUP, was up 0.4%. Gold, and in red, we have bond prices almost the same, up 1.4% for the week. You'll notice something's missing, though, and if we add Bitcoin to the mix, you can see Bitcoin had a pretty decent week here. And actually, hold on, let me add one more day. There we go, the 5-day chart. There it is. I was going to say, starting on last Friday because Bitcoin had a pretty strong weekend. You take last Friday to this Friday, Bitcoin up 13.5%. So I've had some excitable texts with my friend Adrian Zadunchik talking about this rotation. He and Jeff Hirsch did some really interesting work on seasonality, kind of early analysis on seasonal trends for Bitcoin. We'll hope to have a conversation with them very soon on the final bar to share some of their insights. But overall, fourth quarter tends to be pretty strong for Bitcoin. We're starting to see that. And certainly this week continuing that optimism. And I think a lot of that optimism driven by the potential of further adoption, further awareness, and further access, right? The ability of investors to access Bitcoin, not by opening a digital wallet, which a lot of investors don't want to do, but actually doing it in an ETF wrapper, which would be very accessible for a lot of investors. There's been optimism, there's been promise of that, and speculation that it's coming very soon, and you're seeing Bitcoin as a result popping up pretty good on that news. All right, let's continue on here and just look briefly at a daily chart of the S&P 500. I just want to highlight the fact that my conversation with Tom Bowley was a lot of fun yesterday. A lot of my recent conversations during the sort of rotation lower, Marielle McGonigal, same thing. Just thinking of this market, free fall may not be the right word, but it's the one that comes to mind as I'm glancing at this chart. I remember years ago, one of the charts that was passed around through my community of technical analysts was someone had turned a chart of the S&P into a diving board, and this used a bunch of trend lines and circles to draw this person diving off the S&P, and I feel like that would be an opportune sort of time to unleash that sort of graphic out to humanity, based on what we're seeing here. And again, you can come up with that sort of bearish trend analysis through a number of different ways, but I would say the chart just sort of speaks for itself, right? Lower highs, lower lows, levels of support are not holding. Instead of being above moving averages, we're below them. We've broken trend lines. We'll come back to that when we get to the mailbag, and now we can draw trend lines from the recent highs. So when that's sort of the rotation you've seen, I think of this market now as guilty until proven innocent. Back here in May, June, it's innocent until proven guilty. You assume that trend of higher highs and higher lows is going to continue until it doesn't, and that's why the lower high breaking to a new swing low, all those things sort of show how it's changed. Now I think the market is bearish until you see otherwise. We're making lower lows and lower highs, which means, quite simply, we need to make a higher low and a higher high, and that's what would reverse this trend. And you just think about how we would need to see a very different condition than we're seeing right now. The S&P finishing the week oversold, by the way, with an RSI below 30. And before we get too excited, what that often indicates is a bounce within a downtrend, right? You need to see something more from more of an accumulation. And worth noting, by the way, you don't have a bullish divergence anymore. I had some questions about that yesterday, the day before, when we see the S&P going lower and the RSI isn't quite oversold. We're kind of there, so I think that eliminates that prospect of a bullish divergence for the S&P. Really indicates that all likelihood we have further deterioration to go. That's where my mind is at. That's generally how I'm positioned, and I'd encourage you to think more about capital preservation than capital growth until we see some sign of improvement. I also want to note just really quickly, I have an intraday chart that I look at not too often, to be honest with you, but this is my just 5-day, 5-minute chart. I just want to highlight, we talked about this a little bit on the show yesterday, but just look at the last hour of trading. Some days have held in there okay, but going into the close, you often kind of get this rollover. It was magnified yesterday. It was magnified on Monday's session. And again, just this today, you got a little bit of a bounce. We really didn't get any broad signs of accumulation, right? And I think one of the things to look for in this sort of environment, right? What would you look for that would give you signs of optimism as a teaser, sort of a taste of what I would say an improvement in the last hour, right? Signs that institutions are actually accumulating on weakness. I don't think you're seeing that enough to get super optimistic about the market conditions here. We've gone through some of the measures of breadth so far, and I'll just highlight one of those that I think is pretty interesting. The McClellan oscillator for me is one of those kind of short-term indicators, still below zero. And breadth conditions right now are really continuing to be more signaling further deterioration. What's great about conditions of market breadth is as a market is going lower, you'll often see improvements in breadth before the broad indexes actually reflect that. And it's because a lot of those individual names will start to improve. You'll see people buying certain names before the major benchmarks really can rotate. Think of those as like the big Titanic kind of rotating. You get some of these smaller boats that are able to pop up pretty quickly. and that's what causes that change in breadth. And again, we're just not seeing that yet. So I would be keeping an eye on the McClellan oscillator, other breadth indicators to look for signs of a pop higher. Just to finish off here, I did want to look at a chart list called the Magnificent Seven and Friends. This is a chart list that I set up a while ago just to track these 8 stocks that I'll show you here in a minute. And I just want to go quickly to finish up our Wrap the Week segment through each of these and just reflect on where they're at. And again, I think it should be helpful just thinking about the individual names and what we're seeing, but also thinking about what they tell you about the overall market as a whole. So let's start off with this one. When I'm looking at the chart of Apple, the thing that jumps out to me is a trend line that you can draw from the recent highs. And again, not that this game that we do as investors is ever easy. I would argue it never is. I think you can have straightforward approaches, but I think just the challenges of being successful consistently as an investor, it's not easy, right? I mean, and this, it's a frustrating game that we're trying to play here. But there are some times when things feel very straightforward, and this is one of those times on a chart like Apple. We're making lower highs and lower lows, and what a stark contrast to the first half of the year with the total opposite, right? Higher highs, higher lows. You can draw trend lines off of the lows. Now we're rotating lower. This trend line off of the highs, I think, is a really important one because this gives you space for the market to have a counter trend rally, but still be within a downtrend. When we break above that trend line, again, not that it's the perfect trading system that I think you want to bet the house on, but it would tell me that we're seeing enough of an improvement that if I'm not in Apple yet, I better start reconsidering like a short position or being out of the stock at that point, which means we've got a lot of room to bounce before we hit that trend line. And it gives you a quick, clear sense of where you want to watch. Look at the momentum, which is now in the bearish range, right? The RSI stalling out around 60 on these rallies here. So it really is just a classic bearish phase. So higher low, breaking above the trend line, that's what I'd be looking for. But Apple in a clear deterioration. Microsoft a little bit different. You could look at Microsoft, while Apple, I think, in a clear sort of downtrend phase. When I'm looking at the chart of Microsoft, I see more of a consolidation than anything, to be honest with you, right? I'm sort of seeing this as the main pattern. I see this as sideways, right? We kind of rallied into a new high in July. We pulled back, but we're not really making new lows. We're not really making new highs, right? This gap this week, stalling out on the breakout. I think gapping higher and trading lower is never a great sign for the stock, not a great sign for the broader market. The fact that a company reporting strong earnings, gapping higher, buyers did not materialize, right? You didn't have people buying in and riding this stock higher. You saw people unwinding positions, just thrilled to get a pop in Microsoft and take some profits and at least bag something in the green before things rotated lower. And I think that tells you a lot about the sentiment right now. But Microsoft is not a horrible chart, right? It's not a broken chart. It's a chart that's going sideways. I think breaking below 310, getting below that level, getting below the 200-day would put it more in the category of weaker charts that we've seen. Speaking of weaker charts, Tesla's it, right? I think Tesla is one of those great indicators. A couple of weeks ago, we talked about this consolidation pattern. One of the things I remember saying something like this was Tesla may be a good indicator for the market, right? We break out here. That tells you investors are willing to accumulate stocks like this, potentially a long-term, good story breaking out to the upside. But if we gap to the downside, if we break out of this pattern to the downside, that tells you more of a risk-off environment. Unfortunately, that's what we got. And after the gap, you didn't see any additional buyers in there. We've now traded below the August low. We're now below the 200-day. We're finishing at the lower end for the week. So overall, Tesla, I would say, very much in a distribution phase. Meta reminds me a lot of Microsoft two charts ago here, right? Kind of a similar rectangle kind of pattern, right? So you sort of draw it like this. This is how I generally think of the chart of Meta. Not horrible, not great. It's, charts can go up. They can go down, they can go sideways. I think Microsoft and Meta are sort of in that sideways phase. They've pulled back this week, but they haven't broken down. And again, in this sort of environment, charts that haven't broken down are actually quite impressive on a relative basis. Netflix, a lot more like the Apple chart, kind of in a downtrend. You can draw a trend line off of these recent highs. I think watching that go higher, the momentum more negative. NVIDIA, finishing the week breaking down through that neckline. I think that measures down to 340, 350. I think there's further deterioration to be had there. Amazon, arguably, the best chart out of the bunch in terms of how it finished the week, in terms of gapping higher on earnings, up 6.8% today. The momentum isn't horrible, right? So we've sort of gone down below 30, but not by much, and kind of rotated higher a little bit. It's below the 50-day, so I think regaining that next week would cause Amazon to be a much more compelling chart than it is here. But overall, you're not really getting a bullish divergence. I think this is a bounce off of the 200-day. And as with any stock, I'd like to see if it can hold the 200-day. And that gets us to Alphabet, the last of these 8 stocks, gapping lower, trading lower. So, some of these names like a Microsoft gapped higher and then traded lower. Charts like Alphabet gapped lower and trading lower. And that trading lower part of those sentences is what's most important, right? In a bullish phase, buyers come in and they're thrilled when something gaps lower and they can get in. When something gaps higher on good news, they're willing to trade it even higher, follow that trend higher. We're not getting that follow through. We're getting the bearish version, which is people are taking profits anytime and anywhere they can. That is our wrap the week segment here for the Friday. Thanks so much for joining me for that. Just a couple announcements here quickly before we open the final bar mailbag. And mainly is to tell you the mailbag is fueled by people like you. During our live broadcast, just drop a comment in the chat and we'll look for your questions there. Of course, you can put a comment below the video that you're watching. We get some great comments here and chats recently with some of our guests. Really appreciate that. And of course, email always works. thefinalbar@stockcharts.com. That's probably the best way to get your questions in front of us. On Monday's show, we'll be doing another live Q&A, so make sure you tune in live at 4 p.m. Eastern. You have a chance to ask questions directly. We'll do a quick market recap and then spend the rest of our time just taking live chat questions. So join us live this coming Monday. I think that's October 30th. And that's it. Let's continue on with our final bar mailbag. Thanks again, everyone, for the great questions. We picked some of the questions today. Actually, most of them come from our live chat through the course of this week. And here's question number 1. Earlier this week, we featured the 10-year versus 2-year Treasury Yield indicator. And we asked, how do I create that chart? So I love your question for a number of reasons, mainly because you're watching the show, you're seeing something that we're showing, and you're thinking, how can I create that on my own StockCharts login? I love where your head is at. Thumbs up on that one, and please, those kind of questions are always welcome. Of course, you can hit our support desk if you're looking for something, and the final bar is not available at the moment. But of course, that's a great question. Let's look at the chart I think you were referring to is probably the one that I have in the Mindful Investor Live chart list. This one right here. So I had a couple different places where I show 10s versus 2s. And again, this is a common way of just looking at the shape of the yield curve, right? In a normal yield curve, the 10-year point is higher than the 2-year point. The 30-year point is higher than the 3-month point. And that kind of gives this natural upward slope. And that's why that's really the business that a bank is in, is borrowing money in the short end at a lower rate, lending it out to you to buy a house or buy a car or open a small business loan or something. And they're lending it out over a longer period of time, and they're making money based on that slope of the yield curve. So an inverted yield curve, not a great environment for a regional bank where that's really what they're making money on. That's kind of how a healthy economy should be functioning. We've had that inverted yield curve, and to directly answer your question, you want to do this. You want to do this down here. You want to use an indicator called price. You can also do price dash performance, but I would just do price if you're looking at yields. If you're looking at interest rates, it makes more sense to do it that way. And then you just use this syntax: $UST10Y minus $UST2Y. And you could use any tickers for that. That's the way you do a spread. You can also do a ratio. And if you want to do a ratio chart, by the way, and this is how I do some of the relative, I actually have one right here. Price performance as the indicator, and then just do the first ticker, a colon, and then the second ticker. So this is an indicator showing value versus growth. So I have IWD colon IWF. And that'll allow you to do that relative performance. So this is a great way to look at the spread between two interest rates, something that's quoted in percentage terms already, which an interest rate is. You can just do one minus the other. You don't have to use a log scale, just show it just how it is, and it'll probably make sense to you. And that's how I look at this one. And again, I think this is an interesting way to just show the shape of the yield curve as a data series that you can look at over time. Now, if you really want to think about the relationship between the yield curve and stocks, I would point you to one of the great hidden features, I think, of StockCharts. Go to Charts and Tools. In the right column, Dynamic Yield Curve. This is a simple visualization that our developers created years and years ago, and it's just still so powerful. I love it. You can basically go back to a period on the right. This is the chart of the S&P 500, and you'll see what the yield curve looks like from the 3-month point out to the long bond. And this shows you in a normal kind of bullish phase, things are good. You have that normal upward slope to the yield curve. When you get to the environment that we've been in here more recently, you can see an inverted yield curve where the short end is higher than the long end. You can see it says inverted down there just to show you that that's the case. And that's where we're at today. So again, that is a condition that more is in line of an economy that's starting to struggle. Usually means a recession is around the corner. We'll get to additional thoughts on that question here in a minute because I have another mailbag question that addresses with that particular issue. But I would look there next. Next question. Remember the bearish trend line that held all last year and then it broke. Are we seeing the complete opposite right now? And this came again from our live chat earlier in the week. And I love this question. The line that I think you were referring to is this line right here, right? If you take a trend line from the October 22 low, connect that to the March 23 high, as we were sort of rotating lower, actually, started to make maybe a lower high. I remember drawing this trend line and saying, all right, or at least pointing out this trend line, saying, look, as long as we remain above this trend line, I think you could argue this is a pullback within a bullish phase. That's kind of what happened here in December. It's kind of what happened in February into March. You had a 6-week decline down to this trend line. We kept going. So the question was, do we pull back and sort of hold that level of support? We did not. And I think the fact that we broke that trend line is one of those checks on the the market has topped out list. If you have one of those, a trend, breaking trend line support, breaking key moving averages, head and shoulders tops, divergences are all part of that, I think, bullish top scenario. And I think we did it. So breaking that trend line, I think, was incredibly important. So now what? So what you do, and on the chart of Apple, I had a great one, and some charts, follow those trend lines just brilliantly. I think Apple's is probably the most important one I would be watching. On the S&P, you can do the same thing. I have a purple trend line that I took the high from July, connected that to the highs in August and September. I think that's an important one that actually, as we're speaking real time here, I'll move this down the road a little bit. I think this is an important one we're probably going to be watching because if we would rally, it basically says as long as we remain below that trend line, then this is still a downtrend overall, right? But you also have to note that we've made a lower high that all of a sudden is kind of far away from that trend line. So another thing you can do is actually draw a secondary trend line, take it from that line and kind of go it there. So if the market accelerates, what you do is you actually just use a steeper trend line to track that move. And then what that allows you to do is just kind of continue to follow. If the slope of the decline increases, you can just keep drawing a trend line to match that acceleration. So, at the very least, getting back above this trend line, which would mean the S&P would get above trend line resistance above the 50-day. I mean, until we do that, there's no reason to be particularly bullish, especially if we get a nice tradable bounce. Bear market rallies, as I've mentioned in previous bear markets, there is nothing more seductive, sudden, significant, and seductive is the word I would stress on a bear market rally, right? When the larger trend is down and you have those big rallies, all the bulls start getting really loud and really excited because they say, hey, that was the low. Even this week, intraday, I've had people pinging me and saying, that was the low, book it, like date time stamping. Again, as I'm looking at the market making a new low for the week, I'm telling you, I'm not seeing it yet. Okay, I'm glad we're all excited, but I'm not seeing that yet. And I'd rather be patient and wait for a rotation and wait for a break above some of those trend lines that you can track down there. So I think we are seeing the opposite. I think the market at this point is now guilty until proven innocent, which means you have a lot of room for a tradable bounce. If you're a swing trader, I think there could be opportunities on the way down. That's something to think about. But as a medium-term investor, I think you want to be patient in this environment. Great question, by the way. Next one. Historically, Dave, a recession happens 3 to 6 months after the yield curve goes back above zero. Is that right? And the answer is, yeah, you're actually pretty good. And what's really cool about charts is one of my former analysts at Fidelity, Mark Dibble, shout out to Mark and the team there, just one of the most thoughtful and really brilliant technical analysts I've ever worked with. Just a really consistent process for decades that I tried to learn as much as I could. Even managing Mark, I learned probably more from him than he certainly did from me. But one of the things he would say is that the charts are the truth serum for the markets. And we would find that at a big money management firm. There would be a lot of talk about what happens and how things are, and we would just love to bring up a chart during the conversation and say, well, actually, did you know this is the relationship? Here, it's right there on the screen. Look at what happens. So here I'm using stock charts in a little different way. You might not have used it like this, but I'll show you what this chart is and how you can set it up for your own, by the way. So basically what I'm doing is I'm starting with the 10-year minus the 2-year. This is that spread that we were asked about earlier. I basically made a chart, a weekly chart, using that as the main data series, and that's here in black. I then, above there, have the Fed funds target rate, which is $$ Fed rate. And again, you can see at the bottom here, if you hit pause on the video, you can see exactly how we set this up with the different indicators. So I put Fed rate above the main series, and then the S&P 500 using log scale, and I put that just below, and that's what you're showing here. Then I just looked at a different website to find the recessionary dates going back for the last 30 years, 35 years, and I put them as shaded areas. I just used the annotation tool, and it's kind of amber colored. I like to do them as a vertical line to highlight recessionary periods so I can see this relationship. So let's look from 1990 on, look at the relationship between these different series. So first off, we have the yield curve inverting, and the way that I'm defining that here is the 10-year is lower than the 2-year, right? So if that 10 minus 2 spread goes negative, and I have this horizontal line in purple here around 0, so if you go negative, that's the first thing that tells you something's up. The next thing is you often get the Fed lowering rates, because at the point when the yield curve starts getting inverted, that means the economy is probably struggling, and that means the Fed can probably want to lower rates to make things more affordable, to encourage people to take loans and buy things and borrow more aggressively, which usually causes the economy to do well again. So we sort of get the slowdown after the inverted yield curve. You can see the recession is here. In amber, by this point, the Fed has lowered rates, and you can see stocks actually usually sell off during the recession, but look what happens after the recession. You actually have a pretty good, decent recovery. Then in 2000, 2001, the yield curve inverted here in early 2000 as it went below 0. You can see stocks, of course, had already started to sell off because of the tech bubble. You know that as the tech bubble burst and as stocks were going down, the Fed started to lower their target rate. We can see that the yield curve steepened and normalized. This is the recessionary period. We did have a brief bounce. I would argue 9/11 sort of extended this maybe further than it would have otherwise, but eventually you did get a low. It took a little while later into 2002, really into March of 2003, thinking back, until it really felt like the market was starting to recover. 2008, 2009, we have the financial crisis again. Everything I just said the same. Inverted yield curve, recessionary period. The Fed has lowered the target rate. Stocks are going down. After the recession is over, stocks starting to improve a little bit. 2020, all those same things happen. Inverted yield curve, Fed bring the blah, 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 blah. Now, where are we at today? Well, we've only done one of those things, right? So far, the inverted yield curve has happened, and that actually started happening in mid-2022, if you use this particular comparison of 10-year yields minus 2-year yields. We are still inverted, although we're getting very close to not being so. So the things that I would expect if this playbook persists would be probably you start to get the Fed lowering rates. And notice how the Fed usually starts lowering rates before the recession actually triggers. That's what's happened going back here. But stocks usually sell off. The recession is usually recognized by the economic data getting a lot worse. Then you start to get the recovery after there. So when you hear sort of a lack of long-term optimism in my brain, it's because of that sort of succession of things. And again, the delay that you mentioned, the chart tells you, right? The yield curve inverts. It's actually when the yield curve comes out of that inverted condition when the recession usually starts well after that. So that is 100% right. And again, great inspiration to use charts to really look at the evidence in particular. Next question, can you suggest a simple technical analysis book? If not, please compile all your knowledge in one book. I love that so much. On my list. It's on the rainy day list. And again, living in Seattle, you'd think you'd have way more time for the rainy day list, but it is on my list. I will get to it at some point, not today. And I'm not writing a book at the moment. At some point, I probably will. You may not see me on the air as I try to find time to do that. So what would I encourage you to do? So on my website called marketmisbehavior.com, do that. And on the top, you'll see a button for the reading list. It's a great list of books. And if you're just getting started, there's a lot of really good books on there that you can find. Two that I would draw your attention to. The first one I read, which I encourage you to start with, John Murphy, who is the chief technical analyst here at StockCharts. His book is still, I think, the best introduction to charting and why technical analysis makes sense. His first chapters where he talks about the justification for charting, brilliant. That's called Technical Analysis of the Financial Markets. The second one I would suggest you read, Michael Carr wrote a book, C-A-R-R, called Smarter Investing in Any Economy. And if you read his book, it's all about relative strength. I think one of the things that institutional investors know very well and individual investors and advisors need to focus more on, it's the importance of relative strength. Most of my guests this week, like Tom Bowley, like Mary Ellen McGonigal, many others that I've had, all use relative strength as a key input because that shows you the relative performance of that stock versus other stocks, and I would encourage you to look at those. Again, marketmissbehavior.com, click on reading list at the top. You can get more ideas if you're looking for something to read. Finally, what do you need to see in order for the market to have a significant bounce and a move higher? And I really appreciate that question. Just with the few moments we have left, I would encourage you to go back. My conversation with Tom Bowley I thought was really, really interesting. I mean, the general way that I would think of, the markets and what you're looking for, I would just remind you that the technical toolkit kind of has three different types of indicators, as I would generally describe it as I'm making the chart here. You have the leading indicators, which anticipate that a low is going to happen. You have the coincident indicators telling you something is happening right now. And then you have the lagging indicators that tells you something has just happened and you're confirming it. And I would think with any chart that you're using, it's usually helpful to have a little of both, which is what I try to do. So on this chart of the S&P 500, what are the three, what indicators could we use just from what you see that combine that are in each of those categories? In terms of a leading indicator, I would be looking for a divergence. I would be looking for the price of the S&P to make a new low on higher momentum. There was speculation earlier this week. Is this it? It is not. I think the fact that the RSI finished oversold tells you all you need to hear about the momentum right now. The momentum is negative. It's bearish momentum. The RSI is well below 50, and it's even oversold now, which is not what a bull market looks like. So I don't think you're seeing enough of a divergence yet. Doubt they were looking at the S&P and the NASDAQ, right? An equal weighted S&P and NASDAQ. See if one makes a new low and the other one does not. That would be a similar sort of divergence. Divergences are early. They tell you something may be starting to change. In terms of a coincident indicator, Tom Bowley did a great job yesterday. Again, make sure you check that one out. He talked about, and actually his previous appearance, which was about maybe a month or two ago, he talked about looking for a capitulation day, right? A capitulation candle, a hammer candle, a bullish engulfing pattern, something showing you that people are buying weak and driving it higher. My conversation with Ralph Acampora that we recorded a month or two ago now that I think about it, when he was here in Redmond in September, same idea. We were talking about, in October of last year, that bullish engulfing pattern almost jumps off the chart at you. For him, that told him that the market was probably bottoming out. So something telling you today there are buyers coming in. Again, I don't think you saw that this week yet. The final thing would be a lagging indicator. I think something like MACD or PPO is a great lagging indicator, and looking for something like this to register a buy signal is always a good lagging indicator. I would probably, given the strength of this weakness, I'd be looking at the weekly MACD or the weekly PPO to see if you get some sign of improvement, because you do get these little head fake signals on the PPO indicator during a rally, during a bear market rally. But overall, some sort of confirmation that the market is rotating higher, and that would happen after those first two things. So those are the three sorts of things I would look at. For my premium members of Market Misbehavior, we have a whole bear market bottom checklist, which we would look at. Those are some of the things that I would probably include if I was making my own checklist from scratch. Great questions today, and thank you guys so much for using the chat, for using the comments, for sending us emails. We love to hear from you. Keep them coming, and we'll do more and more mailbag segments to feature some of your questions. We've got to wrap the show and go to the 3 in 3, 3 charts in 3 minutes that tell the story of this market environment. Here, folks, is chart number 1. As I'm trying to take a step back this week and thinking about the distribution, I wanted to set up this chart just looking at a bunch of different things versus their 50-day moving average. And you wonder, if you ask, what are you seeing right now that convinces you the market is going down, right? That we're in a downtrend. From the top, the S&P 500 is in a downtrend phase, lower highs, lower lows, below a downward sloping moving average, 50-day moving average. Everything I just said is also true of transportation. This is the XTN, a transport ETF, basically follows the Dow Transportation Index. ITB is a home builder ETF. QQQ, the NASDAQ 100, looking at the mega cap kind of magnificent 7. All 4 of these are making lower lows and lower highs below a downward sloping 50-day moving average. The moment I can't describe the market with that condition, that sentence that I just made, is when I'll start to be optimistic about market conditions. For now, we are a market in a downtrend. Chart number 2, Crude oil, a bit of a consolidation phase. Remember the chart of Tesla we highlighted, we looked at earlier during our Wrap of the Week segment. It was that triangle pattern, what we call a coil pattern. Lower highs, higher lows, sort of coming around an equilibrium price, and then you wait to see which way we break. The USO, the crude oil future, all sort of in that similar kind of pattern. And what you basically do in this environment is you wait, and you wait to see whether we break above the upper boundary or below the lower boundary. I think that'll tell us a lot about where we're at next, right? The direction of momentum after that break. Tesla broke down and then continued to go much lower. Do we get a breakout to the upside for crude oil prices? Events in the Middle East continue to escalate over the weekend into next week. You very much could see that as a possibility. Finally, 4 stocks making new swing highs. Can we finish the week on a positive note? A week of distribution, a week of market declines. What's actually working? Mary Ellen McGonigal on Wednesday's show, I thought did a great job sharing some stocks that she is seeing some upside opportunity, and I'll share some of the ones that I'm scanning for stocks making new highs. Here are some ones that came up. Murphy USA. We talked about that as a cup and handle pattern, validated, continuing higher even through the course of this week. FTI is an energy stock above an upward sloping 50-day moving average. X is U.S. Steel, so we have materials names above an upward sloping moving average. This last one, also in an upward trend, higher highs, higher lows, above an upward sloping 50-day. Bad news, that's actually the 10-year yield. So I don't know if that's a great way to end the show, but that's where we're at. Yields, I would argue, still very much in an uptrend. Folks, that's a wrap for this show. Thank you so much for joining us this week and always on the Final Bar. As a reminder, go back to some of those interviews. They've been really helpful this week. And don't forget to like this video, subscribe to our channel here while you're here. We would so much appreciate that. Have a great weekend. Go Bucks, go Seahawks. We'll see you next week.